On the morning of Friday, September 14, 2007, Robert Peston, the BBC's business editor, broke a story that would change British banking forever. Northern Rock, a medium-sized but growing mortgage lender based in Newcastle, had requested emergency funding from the Bank of England. The bank was facing a liquidity crisis. It couldn't roll over its short-term borrowing. Without central bank support, Northern Rock would collapse. Peston's report went live on BBC Evening News. By the next morning, Saturday, September 15, queues had formed outside Northern Rock branches across Britain. Worried customers wanting to withdraw their savings before the bank failed. By Monday, the queue stretched around blocks. Thousands of people waiting for hours. Some had brought folding chairs and camping equipment, prepared to wait overnight if necessary. Over the following days, customers withdrew £1 billion on the first day, £2 billion total over 3 days. Branch staff were overwhelmed. Computer systems struggled under the volume. The scenes were broadcast globally, images of desperate British citizens queuing to save their money dominating every news channel. It was the first bank run in Britain in 141 years, since Overend, Gurney and Company collapsed in 1866. For a nation that prided itself on financial stability and sophisticated banking, the Northern Rock queues were a profound humiliation. Britain was supposed to be a first-world financial centre, not a country experiencing bank runs like some emerging market in crisis. But here's what matters right now in December 2024. Everything that made Northern Rock's collapse possible exists today in more dangerous forms across multiple banks in Britain, America, and Europe. Banks funding long-term assets with short-term borrowing that can disappear overnight. Depositors who can withdraw money instantly via mobile apps without needing to queue. Social media that spreads panic faster than any BBC report ever could. And regulators who still haven't learned that deposit insurance and lender of last resort facilities don't prevent runs when confidence evaporates. They just delay them until the panic becomes overwhelming. Based on every pattern from Northern Rock and every current banking stress indicator, we're approaching bank failures in 2025 or 2026 that will make the 2007 queues look orderly and slow by comparison. The warning signs are flashing. The vulnerable institutions are obvious. The triggers are in place. And when the next bank run starts, you won't have time to queue. You won't have time to drive to a branch. It will happen via phone apps in hours, not days. And by the time the news reports it, the bank will already be dead. To understand why Northern Rock collapsed and why it's about to happen again, you need to understand the business model that killed it. Northern Rock wasn't a traditional British bank. Traditional banks like HSBC, Barclays, or Lloyds funded their mortgages primarily through customer deposits. People put money in savings accounts, the bank used those deposits to make mortgage loans. Simple, stable, boring banking that had worked for centuries. But Northern Rock had a different model. They funded mortgages through wholesale markets, borrowing short-term from other financial institutions and using that money to make long-term mortgage loans. This worked brilliantly during good times. Northern Rock could grow much faster than traditional banks because they weren't limited by how many customer deposits they could attract. They could just borrow in wholesale markets and make more loans. From 2000 to 2007, Northern Rock grew from a regional building society into one of the UK's largest mortgage lenders. Their market share went from 6% to nearly 10%. The bank was celebrated as innovative and aggressive. Management was praised. Stock price soared. Everyone assumed the model was superior to traditional banking. The fatal flaw was obvious to anyone thinking about what happens during stress. Wholesale funding can disappear instantly. Customer deposits are sticky. People don't usually pull all their money out of their savings accounts even during economic difficulty. But wholesale lenders, other banks and financial institutions will cut off funding immediately if they smell trouble. And once the funding stops, a bank like Northern Rock dies within days because they don't have deposit bases to fall back on. The business model only worked as long as confidence remained perfect. The moment confidence cracked, the entire structure collapsed. The crack came from America. Through 2006 and early 2007, the US subprime mortgage market was showing serious stress. Home prices had peaked and started falling. Borrowers with adjustable rate mortgages were defaulting. Mortgage-backed securities were losing value. American banks and hedge funds that held these securities were taking losses. By summer 2007, the problems were spreading beyond subprime to the broader mortgage market. Credit markets were freezing. Banks were becoming reluctant to lend to each other or to anyone because nobody knew who held toxic mortgages and who didn't. This created an immediate problem for Northern Rock. They needed to constantly roll over their short-term wholesale borrowing. Every few months, loans would mature and need to be replaced with new borrowing. In normal times, this was routine. But in August 2007, when Northern Rock went to wholesale markets to roll over maturing loans, the lenders weren't there. Credit markets had seized up. Nobody wanted to lend to mortgage lenders. Northern Rock tried to borrow. They offered higher interest rates. Nothing worked. The wholesale funding that the entire business model depended on had vanished. By early September, Northern Rock was in crisis. They had assets, their mortgage loan portfolio was mostly performing. But they had no funding. They couldn't pay depositors who wanted withdrawals. They couldn't make new loans. The mismatch between long-term assets and short-term funding was killing them. On September 13, Northern Rock executives went to the Bank of England and requested emergency funding as lender of last resort. The Bank of England agreed to provide liquidity. But there was a condition. The support had to be announced publicly to comply with transparency rules and European Union regulations. This public announcement is what triggered the run. Robert Peston's BBC report on the evening of September 13 told the nation that Northern Rock needed emergency Bank of England support. To sophisticated observers, this meant the bank was in trouble but being supported. To ordinary depositors, it meant their bank was failing. The psychological impact was immediate. If the Bank of England had to step in, Northern Rock must be on the verge of collapse. Better get your money out now before it's too late. The rational response to that information, if you're an individual depositor, is to withdraw your savings immediately. Even if you believe the bank will probably be fine, the risk of being wrong is catastrophic. Better safe than sorry. Saturday morning, September 15, the queues began forming. At first, dozens of people. By afternoon, hundreds. By Monday morning, thousands. The scenes were extraordinary. Middle-aged and elderly customers, people who'd banked with Northern Rock for decades, waiting hours to close their accounts. Some brought thermoses of tea and sandwiches, prepared for long waits. Others were visibly distressed, worried they'd lose their life savings. Branch staff worked frantically to process withdrawals, but the systems weren't designed for this volume. Each transaction took time. The queues grew longer. As the day progressed and news cameras broadcast the scenes, more people joined the queues. Seeing others panicking made you panic. Social proof in action. The Bank of England and government tried to calm the panic. Chancellor Alastair Darling gave statements assuring depositors that their money was safe, that the Bank of England was providing unlimited support, that there was no reason to withdraw funds. But words couldn't overcome visual evidence. When people see queues outside their bank, when they see neighbors and friends panicking, reassurances from officials sound hollow. The run continued. £1 billion on Friday and Saturday. Another billion by Tuesday. At this rate, Northern Rock would be completely depleted within a week. On Monday, September 17, the government made an unprecedented decision. They announced a full guarantee of all Northern Rock deposits, not just the amounts covered by deposit insurance. Every penny held at Northern Rock was now backed by the British government. This was a massive escalation. Deposit insurance at the time only covered the first £2,000 in full and 90% of the next £33,000. Large depositors faced potential losses. The full guarantee removed that risk. It was desperate but necessary. Nothing short of a government guarantee would stop the run. The guarantee worked. The queues disappeared almost as quickly as they'd formed. Depositors stopped withdrawing because the government had essentially nationalized the bank's obligations. But the damage was done. Northern Rock's reputation was destroyed. Their business model was proven unworkable. Through the fall of 2007, the government tried to arrange a private sector solution, finding a buyer for Northern Rock. Several banks looked but walked away. Nobody wanted to buy a bank that had just experienced a run and needed billions in emergency funding. In February 2008, 5 months after the run, the government officially nationalized Northern Rock. British taxpayers now owned a failed bank. The Northern Rock collapse should have been the wake-up call for the entire financial system. It proved that sophisticated financial institutions in developed countries could experience bank runs. That fancy business models relying on wholesale funding were fragile. That once confidence breaks, institutions die quickly regardless of asset quality. But the lesson wasn't learned. Most observers dismissed Northern Rock as a unique case of mismanagement. They noted that Northern Rock's business model was unusual. Traditional banks didn't have the same vulnerabilities. The system was fine. Just one bank screwed up. Exactly 1 year later, Lehman Brothers collapsed. Bear Stearns had failed 6 months before that. The global financial crisis that Northern Rock warned about in September 2007 fully materialized in September 2008. Banks across Britain, America, and Europe failed or needed bailouts. RBS required £45 billion in taxpayer support. HBOS was forced into emergency merger with Lloyd's. In America, Washington Mutual, Wachovia, IndyMac all failed. The pattern Northern Rock revealed, that even supposedly safe institutions could collapse in days when funding vanished, played out across the entire financial system. Now here's where Northern Rock becomes the blueprint for 2025 and 2026. Every element that made the 2007 bank run possible exists today in more dangerous forms. In 2007, customers had to physically go to branches to withdraw money. Lines formed because processing took time. Today, customers withdraw via mobile banking apps. No lines. No visible panic. Just billions flowing out in hours. In 2007, news spread through television and newspapers. Today, social media spreads panic instantly. A viral Twitter thread or TikTok video about a bank in trouble can trigger withdrawals faster than any BBC report. In 2007, Northern Rock's problem was wholesale funding dependency. Today, regional banks in America have similar vulnerabilities. They grew by making commercial real estate loans funded through brokered deposits and short-term borrowing. When interest rates rose from 0 to 5%, their funding costs exploded while their assets, fixed-rate loans made at low rates, stayed frozen. The mismatch between assets and liabilities is creating exactly the stress that killed Northern Rock. In 2007, regulators didn't understand how fast a run could develop. In 2024, they're about to learn that mobile banking makes runs even faster. The data showing current vulnerability should alarm anyone paying attention. Silicon Valley Bank collapsed in March 2023 in 48 hours. On Wednesday, March 8, SVB appeared stable. By Thursday afternoon, customers had withdrawn $42 billion via wire transfers and mobile banking. By Friday morning, regulators seized the bank. It was the second largest bank failure in American history, and it happened at digital speed. No cues. No visible warning. Just instant panic spreading through tech startup founders who communicated via WhatsApp and Twitter. First Republic Bank followed 2 months later. Despite receiving $30 billion in deposits from major banks in an emergency support package, First Republic couldn't stabilize. Customers kept withdrawing. The bank hemorrhaged over $100 billion in deposits during the first quarter of 2023. In May, regulators seized First Republic and sold it to JP Morgan. Signature Bank was shut down the same weekend as Silicon Valley Bank. 3 significant bank failures in 8 weeks. The pattern from Northern Rock, that modern bank runs develop in hours not days and spread through contagion, played out exactly. But the underlying problems haven't been fixed. Regional banks in America are sitting on $650 billion in unrealized losses as of late 2024. They bought bonds when interest rates were 0. Now rates are over 5% and those bonds are worth 70 to 80 cents on the dollar. They don't have to recognize the losses if they hold to maturity. But if depositors withdraw and banks need to sell bonds for liquidity, they have to recognize losses. Those losses wipe out capital. The bank fails. This is exactly what happened to SVB. And it can happen to dozens more banks. Commercial real estate loans are the next trigger. Regional banks hold massive amounts of office building loans made when offices were 95% occupied and rates were 2%. Now offices are 60 to 70% occupied and rates are 7%. Borrowers can't refinance. Buildings are worth less than the loans. Banks are extending and pretending, giving borrowers more time, hoping markets recover. But eventually loans mature and can't be rolled over. Foreclosures begin. Banks recognize losses. Capital erodes. Depositors get nervous. Withdrawals accelerate. The Northern Rock pattern repeats. European banks face similar stresses. Deutsche Bank in Germany has been fragile for years. Italian banks hold massive amounts of Italian government debt. If Italy faces another debt crisis like 2011 to 2012, Italian banks holding that debt take huge losses. UK banks are exposed to commercial real estate in London where office vacancy rates are over 20%. The vulnerabilities are distributed across the system, but the pattern is uniform. Banks made loans and bought assets assuming low interest rates and stable economies. Now rates are higher and economies are weakening. The asset-liability mismatch is creating Northern Rock vulnerabilities everywhere. The timeline based on every historical pattern and current stress indicator suggests the next failures arrive in 2025 or 2026. Right now through the first quarter of 2025, banks are still extending and pretending. Regulators are allowing flexibility. The hope is that interest rate cuts or economic improvement will ease the stresses before anything breaks. This is like mid-2007, when everyone knew US subprime mortgages were struggling but insisted the problems were contained. Northern Rock proved they weren't contained. The next failure will prove current problems aren't contained either. The second and third quarters of 2025 are when visible cracks likely appear. Some commercial real estate loan defaults make headlines. A regional bank or two shows serious deposit outflows. Maybe one small bank fails. This is analogous to the spring and summer of 2007 when Bear Stearns hedge funds collapsed and markets started getting nervous. The system is under stress but hasn't broken yet. Most investors still believe everything will be fine. The fourth quarter of 2025 or first quarter of 2026 is when the Northern Rock moment arrives. Some bank faces a sudden run. Maybe triggered by a viral social media post. Maybe because a commercial real estate developer defaults spectacularly. Maybe because some analyst report identifies vulnerabilities and depositors panic. Doesn't matter what specifically triggers it. The point is that once withdrawals start, they accelerate through mobile banking faster than regulators can respond. The bank fails in hours or days. Other banks with similar profiles face runs. Contagion spreads. The next Northern Rock teaches the same lesson the original did. Confidence is fragile and once broken, institutions die quickly. So what do? How do you position before the next Northern Rock? Step 1 is understanding that FDIC insurance in America and FSCS protection in Britain only cover limited amounts. In the US, FDIC covers $250,000 per depositor per bank. In the UK, FSCS covers £85,000. If you have more than these amounts in any single bank, you're at risk. If the bank fails and liquidation takes years, you might eventually recover more, but immediate access will be limited to insured amounts. Spread deposits across multiple banks to stay under limits everywhere. Step 2 is recognizing that not all banks are equally vulnerable. Large systemically important banks like JP Morgan, Bank of America, HSBC, Barclays are essentially guaranteed by governments. They're too big to fail and everyone knows it. Depositors at these banks won't run because they know bailouts are coming if needed. Regional banks and smaller institutions don't have the same implicit guarantee. Governments might let them fail to teach market discipline. Silicon Valley Bank had $42 billion in deposits but only $5 billion was FDIC insured. The other $37 billion was vulnerable. Don't keep large uninsured deposits at regional banks. Step 3 is understanding that Treasury money market funds and short-term Treasury bills are safer than bank deposits during banking crises. Money market funds that invest only in US or UK government securities are backed by those governments. They can't fail unless the government itself defaults. In 2008, some money market funds broke the buck because they held commercial paper that defaulted. But Treasury-only money market funds held value. For cash you need safe, Treasury money markets are better than bank deposits beyond FDIC limits. Step 4 is having multiple banking relationships established before crisis. If your primary bank fails, you need backup accounts at other banks to receive funds and pay bills. Opening new accounts during a crisis is difficult because banks tighten verification and slow down onboarding. Open accounts at 2 or 3 banks now while everything is calm. Keep small balances in each. That way, if one bank fails, you have immediate access to accounts at other institutions. Step 5 is preparing for the psychological reality of bank runs. When you see social media posts about a bank in trouble, when you see news reports of deposit outflows, your instinct will be to withdraw immediately. This instinct is rational. Even if the bank is probably fine, the risk of being wrong is catastrophic. But if everyone follows that instinct, the bank fails even if it was initially sound. This is the paradox of bank runs. Individually rational behavior creates collectively disastrous outcomes. You can't fight this psychology. Just make sure you're positioned so you're not caught in a run. Stay under FDIC limits. Use systemically important banks. Keep backup accounts ready. Here are the 5 specific warning signals that will tell you the next Northern Rock is approaching. Signal 1 is deposit outflow data for regional banks. The Federal Reserve publishes weekly data on bank deposits. When you see regional banks showing persistent deposit declines while large banks show deposit increases, it means customers are moving money from smaller banks to too big to fail banks. This flight to safety precedes bank failures. In early 2023, before SVB collapsed, regional bank deposits were declining for months. Track this data weekly through Fred Economic Database. When regional bank deposits fall 5% or more from recent highs, the stress is building. Signal 2 is the VIX Volatility Index for regional bank stocks. This is calculated the same way as the regular VIX but specifically for bank stocks. When bank stock volatility spikes above 30 while the regular VIX stays calm, it means the market is specifically worried about banks, not the broader economy. This happened in March 2023 before SVB failed. Bank stock volatility exploded while broader market volatility stayed moderate. Bloomberg tracks this. When bank VIX exceeds 30 and stays elevated for more than a few days, something is breaking in the banking sector. Signal 3 is credit default swap spreads on regional banks and mid-tier banks. Credit default swaps are insurance against a company defaulting. The price tells you what the market thinks the default risk is. In September 2007, Northern Rock CDS spreads exploded from under 100 basis points to over 400 before the run. In March 2023, SVB spread spiked from under 100 to over 800 the day before collapse. When CDS spreads on any bank double or triple in a short period, the market is pricing in imminent failure. Bloomberg and Financial News track major moves. React immediately if you have exposure. Signal 4 is social media monitoring for banking panic. Twitter, Reddit's personal finance forums, and financial TikTok spread panic faster than any traditional media. During the SVB crisis, startup founders were texting and tweeting each other to pull money out hours before mainstream media covered the story. Set up alerts or follow financial Twitter accounts that would catch early rumors. If you see viral posts about a specific bank being in trouble, investigate immediately. Even if the claims are false, they can trigger real runs through fear. Signal 5 is commercial real estate default headlines. Major office building foreclosures or REIT bankruptcies will be the trigger that starts deposit flight from banks heavily exposed to commercial real estate. Create news alerts for commercial real estate defaults, office building foreclosures, and REIT bankruptcies. When major deals start failing and making headlines, banks holding those loans will face pressure. Depositors at CRE-heavy banks will get nervous. Withdrawals will begin. This is your warning to check your exposure to any banks that might have significant commercial real estate loan portfolios. Your 90-day action plan starting right now must prioritize deposit safety and preparation. In January 2025, audit all your bank accounts and total your deposits at each institution. If you have more than FDIC or FSCS limits at any bank, especially regional banks, move the excess. Open additional accounts at large systemically important banks if needed to spread deposits. The goal is never having more than insured amounts at any single institution. This feels paranoid until it saves you from being caught in a run. In February 2025, set up monitoring for the 5 warning signals. Create a simple tracking system with weekly updates on regional bank deposit levels, bank stock volatility, any CDS spread news on banks, social media scanning for banking concerns, and commercial real estate default headlines. 5 minutes per week keeps you informed. Most people won't do this work. That's why they'll be caught unprepared when the next Northern Rock happens. In March 2025, open at least one Treasury money market account if you don't have one. Transfer funds you don't need for daily expenses into Treasury money markets. These pay competitive rates in late 2024, over 5%, while being safer than bank deposits for amounts exceeding insurance limits. Fidelity, Vanguard, Schwab all offer Treasury money market funds with no minimums. This gives you a safe haven for cash during banking stress. From April through December 2025, maintain vigilance on your 5 signals while living normally. You're not trying to predict the exact date. You're trying to avoid being caught unaware. When signals start flashing red, when regional bank deposits are falling and volatility is spiking and CDS spreads are widening, you'll know stress is building. At that point, even if you already have deposits under limits, consider moving more funds to only the largest banks or to Treasury money markets. Maximum defensive positioning until the crisis passes. The parallels between Northern Rock 2007 and today aren't subtle. In 2007, a bank with an unsustainable funding model failed when wholesale markets froze. In 2024, banks with unsustainable asset-liability mismatches will fail when deposits flee. In 2007, the Bank of England tried to provide emergency funding quietly but had to announce publicly, triggering the run. In 2024, regulators face the same dilemma. Support must be disclosed, but disclosure triggers panic. In 2007, customers queued outside branches for days. In 2024, customers will withdraw via mobile apps in hours. The mechanics are faster. The outcome is the same. In 2007, government officials insisted Northern Rock was an isolated incident caused by mismanagement. In 2024, officials insist Silicon Valley Bank and First Republic were unique cases, not systemic problems. They're wrong. Northern Rock was the first domino. SVB and First Republic are early dominoes of the next crisis. More are falling. In 2007, deposit insurance limits were too low and the guarantee had to be expanded to full coverage. In 2024, FDIC limits haven't changed. When the next crisis hits, the government will face the same choice: expand guarantees and socialize losses, or let depositors take haircuts and risk systemic panic. They'll choose guarantees, but the delay while deciding will cause runs. In 2007, the Northern Rock queue shocked Britain and the world. Bank runs weren't supposed to happen in developed countries. They did. In 2024, digital bank runs will shock people even more because of the speed. 42 billion withdrawn in one day, as happened to SVB, would have taken Northern Rock weeks with physical queues. The acceleration makes the system more fragile, not less. Technology that was supposed to make banking safer has made bank runs faster and more dangerous. But there's one crucial difference that creates opportunity. In 2007, investors who understood that Northern Rock wasn't isolated, who recognized it was a warning of broader crisis, positioned defensively and survived the 2008 crash. Those who bought quality assets during the panic made fortunes. In 2024, investors who understand that SVB and First Republic weren't isolated, who recognize their warnings of broader banking stress, can position now before the crisis becomes obvious. The majority won't act until queues appear or mobile banking apps show falling balances. By then it's too late. The opportunity is positioning before the panic. Northern Rock's collapse wasn't about bank management making mistakes. It was about a fundamentally flawed business model being exposed when market conditions shifted. That lesson applies to every bank right now sitting on massive unrealized losses or heavy commercial real estate exposure or deposit bases that can vanish instantly via mobile banking. The flaws exist. Market conditions are shifting. When the next Northern Rock fails, it won't be random bad luck. It will be predictable consequence of vulnerabilities everyone can see but most choose to ignore. If this gave you the exact playbook to protect yourself before the next Northern Rock-style bank run destroys unprepared depositors and creates panic across the banking system, hit subscribe. The queues outside Northern Rock in September 2007 were the first visible sign that the financial system was breaking. The panic was rational. The institutions weren't safe. Today, you won't see queues. The runs will happen silently through mobile apps. By the time you hear about it, the bank will be dead. The question isn't whether more banks will fail. The question is whether you'll be positioned safely when they do.